U.S. Federal Reserve left interest rates unchanged. That was expected. And now the central bank indicating, or data and projections from the Fed indicating that policymakers are in no rush to cut interest rates. We might get 2 cuts this year. Let's get more from Dennis Lockhart, former president and CEO of the Federal Reserve Bank of Atlanta. Dennis, thanks very much indeed for joining us.
Thank you for having me on, Andrew.
One thing you want to point out to investors is that it's plausible, or possible rather, that we get no rate cuts this year.
Well, the summary of economic projections actually showed an increase in the number of participants who are anticipating no rate cuts, as many as 7, which is roughly equal to the number that expect 2. So the sentiment on the committee is shifting at least toward the possibility that they'll have to wait to 2026 before they can resume interest rate cuts.
It seems amazing that they'd be so reluctant, given this threat to the economy from the trade war and disruption of supply lines. I mean, it seems like a given that that is slowing down business investment.
Well, yes, there is threat to the economy, but there's also inflationary risk as well, and they're very attuned to inflation and inflation expectations and trying to make sure that the inflationary effect of tariffs does not get away from them and does not become something more persistent. So as they weigh all of those considerations, what I see is putting the inflationary picture as a priority and making sure that they, at least through into 2026 and beyond, remain on a path of disinflation toward their 2% target.
But isn't the inflation, sorry, I'm being kind of rhetorical with you here, isn't the inflation that is being caused here, it's not because of an overheating economy per se, it's because of tariff chaos, well not chaos, but tariff uncertainty and supply lines, etc. It's not because of an economy that's getting too frenetic.
Correct. It's an unusual factor, the imposition of tariffs, but it's a price increase. The question on their mind is whether it's simply going to be a one-time and very temporary price increase, which technically is not inflation, or it's very short-term inflation, or is it going to trigger something that feeds on itself and becomes more persistent? And they certainly do not want that to happen.
What about the U.S. dollar? I know that's not part of the Fed's primary mandate, but we did see the U.S. dollar, as you know, hitting the lowest since 2022 last week. I know it's edged up a bit. That on the surface is inflationary in the sense that America does import a lot of stuff.
Yes, and import inflation is something they're watching. They watch all the components of inflation, and you cannot ignore the cost of imports, particularly in goods that are imported from China and elsewhere. The United States does a great deal of that, and so the weaker dollar is simply going to add a touch more fuel to the potential inflation fire.
So Jay Powell seems reasonably comfortable with the economy. He says it's a solid economy with decent growth, and he's not particularly worried about the labor market. He says labor market's not crying out for a rate reduction.
Yeah, he described it as cooling, and I think it is cooling. You're seeing evidence that the frenzy of hiring and the frenzy of staffing that we saw post-pandemic has cooled off, and it's a little bit more of an even keel. He, in fact, described the supply and demand for labor as being in rough balance. Yes, he's comfortable with where the economy is. To be, really casual about it, I would say if things are okay, don't fool around. And sort of that's the position that the committee is in right now. They just want to wait and see, particularly how the tariff thing plays out.
If you were to sit down with Jay Powell for a beer right now, just the two of us, just the two of you, and nobody else around, no microphones, what would you ask him, or what would you say to him, do you think?
Well, first I would commend him for what I think is he's doing an outstanding job. I think his position and handling of the noise from President Trump is really commendable. He's just basically staying out of it and ignoring it and keeping his focus on his job. So I would give him plaudits for that. And then having been at the Fed for 10 years, I'd be sort of curious about some inside baseball stuff, particularly the strategic framework that they're working on, which could see some significant changes in the approach to monetary policy in the coming years.
Give us an example of what might be coming down in terms of big changes.
Well, there was a principle called flexible average inflation targeting, the point of which was when there's a period of below target inflation, you might allow above target inflation for a period of time, even years, in order to balance those out so that they're on average over time around 2%. They may very well abandon that because what's happened, of course, is we've had the pandemic inflation, and it's been very high and come down to about 2.5% to 3%. But it just doesn't appear to be a relevant approach given the history of the last few years.